Day, January 30th. We're just going to look through some charts. Last week, we went over looking for the rotations in different sectors, and I just want to look for some fresh setups so we can analyze where we see the markets at and then kind of make some educated predictions or trades based on where we think it's likely to go or the setups that we see. But in last week's video, I pointed this ELV out, and what I said last week was that it could go to 490, right? So if you go back to that YouTube video I posted last week, here's a screenshot from that video itself at the 16-minute and 3-second mark. ELV was at 479, and I was saying, like, yo, this is set up. Most likely it could run to 490, right? If you look at this MACD, it's about to cross over. The histogram is ticking upwards, so it looks bullish, and where it's likely to go is 490, right? That's where the 200-day moving average is. That's where the 20-day moving average is. Everything meets there. That's where it's likely to go. So if you just go look at a live chart of that, what you'll see is not only did it go to 490, it went all the way up to 500, and then it kind of fell. So it got to 500, hit 504, and then it fell down to 492. So now it's above that moving average. But that's how you can catch a move from this area here and going upwards, right? You see how, let's just try to compare these side by side. All right, so we have this last Monday before the market opens versus now, right? So you have the MACD getting ready to cross over and the histogram's ticking upwards. What ended up happening is the histogram kept ticking upwards and the MACD did cross over. So just come look at this chart. Look what happens every time the MACD crosses over to the downside versus what happens to the price every time the MACD crosses over to the upside. So we'll just highlight them. I know if you watch my videos, you see me do this a lot, but repetition is the mother of learning, right? So, all right, we got to cross to the downside. We got to cross to the upside. We got to cross to the downside. We got to cross to the upside. We got to cross to the downside here. We have a cross to the upside here. You see what I mean? When I say cross, the red line goes below, the black line goes below the red line. On the upside, the black line goes above the red line. Now, just go draw with a trending line and an arrow, which way the price moves when the crossover happens, right? So when the crossover happens to the downside, where's the price when it happened and where does it go? Boom. When the crossover happens to the upside, where's the price and where does it go? Downside, where does it go? Right? Upside, just here. Where does it go? Boom. Downside, boom. Upside, here. So you can just see, right? You're not catching the exact bottom or you're not finding the exact turnaround, but you can see once the MACD and the histogram start showing you, yo, this is where price is leaning, then you can start to get an indication of, okay, maybe I can try to jump the gun, or I could put something on my watch list, or I could start setting price targets or support and draw, support resistance. You kind of have an idea of where something is likely to move. I say likely to remove because it's a game of probability, right? So it doesn't mean it's going to be right. So if you have a coin and it's just a regular quarter, right? And you flip the coin, right? And you go, how likely is it to hit heads? How likely is it to hit tails? I say, all right, this is 50%, has a 50% chance of hitting heads. And if it hits tails, it doesn't mean you were wrong, right? Just because it hit tails, you still had the 50% chance of it hitting heads, right? So what you're doing is you're trying to make guesses, educated guesses based on probability, and if they work out in your favor, and they're not 50-50, sometimes they're like 90-10. If they work out in your favor, you make money. So if you can understand that, then you can print money. If you can read a chart, you can print money. So what I like to do before the market opens, boom, you can run a scan. You can go to predefined scans, right? Then you can go to your bullish technical indicators, right? Well, first, before we even get to that, let's go, where is SPY? Right? At all times, you should know where SPY is at. Where is SPY at? Right? What's going on with the SPY? Where is SPY? So this is what you have with SPY. Right? You're just going to take this auto support resistance level. You're just going to draw a line here. Why did we draw the line here? Because when we ran up, we stopped there. Then we fell. Then we ran up. We stopped there. All right. Down, sideways, eventually run up, stop. We're stopping at the same area, right? Even here. It doesn't have to be an exact, it's not an exact number, it's an area. All right. So you see, when we run up, we stop at that area. Then we fall. Then we go up, down, up, down. Then when we finally get back there, we keep meeting resistance in this area, right? So we're going to make note of that. So you see, we go on a bull run. All right. We go on the run. Market goes up, which is dope. Everyone's excited. But we stop in the same exact area, right? We can't get through it for some reason. We can't get through this area. So we have 1, 2, 3 tops, right? We have 3 tops. We hit this key area of resistance and boom, we stop. All right. So what does that tell you? It tells you the market could pull back a little bit, right? And if it blows through this area, we're just going to go to the next area, right? We're just going to go back up here, right? Where this, you can't see it over here, but where this is over here, that's the next target. All right. So I set my targets based on where the price has been before. Let me clear off these charts, honestly. All right. We're going to set our targets based on where the price has been before. All right. So to give you an example of what that means. All right. So the market hits this level of resistance. It starts falling. It starts falling. It starts falling. Right. It's falling, falling, falling. It stops falling. Finally, you take notice and you're like, all right, cool. I want to get in. Right. And it starts to pump. Right. So if you get in here, this spot, you want to set your target to where it fell from. Right. So that could be a target because that's where it fell from. This can also be a target. You see, it started falling. It went sideways for a few days, 3 days, then it fell again, right? So when you get in here, if this is your entry point here, then you can have your price targets set here or here, right? Now, you also need to set a stop loss because if this turns against you, you don't want to just let it fall all the way to zero and it falls all the way to zero and or not all the way to zero, but your account pulls back. It falls down 10, 20, 30, 40, 50% when you could have just got out of your move and waited for it to stop falling, show some strength, and then get back in, right? So we're just going to use this random day as an example. Here's your entry. Here's a target. Boom. Here's another target. Boom. Now you need a stop loss, right? If the price goes to this level, you're out. All right. Boom. You could put this stop loss here. So let's go use this. So let's say you get in here. All right. Your stop is down 2.5%. You need to figure out which price that is. Right. And then here's your target. Your target is up 6% from there. And then the next target's up 11%. All right, we're just using this as a general idea, just a general example. So you get in, and then what ends up happening on this trade, let's take this away, price comes up, right? It reaches this 376 area, and then it fails, right? Comes back down, comes back down, comes back down. Now it goes below where you got in. So now you're negative. You hit your stop, you get out. All right. So if this keeps going down, cool. Right. You're not Captain Save a Stock. This could keep falling, keep falling, keep falling, keep falling. You're good. You set your stop right here. You could even set your stop. You could even set your stop here too. Right. But whatever. You played it safe. You set it down here. It's only 2.5%. You're not tripping. Right. Cool. So, boom, this trade does not work for you, right? It's falling, it's falling, it's falling. Now it starts to show strength, and you get back in. All right, you get back in, you buy here. All right, now where are your price targets now? You can keep those same price targets as you had before, but you can also set one from here, right? Because this is where price fell from, like I said earlier. So you can say this is actually now my first price target because that's where price rejected, right? Price came up, came up, came up, then it stopped in this area, and then it proceeded to fall. So now you get back in where it fell from is your price target. All right. So you can even label this. Let's do price target 1. Price target 2. Now keep in mind this is on a daily chart. Every bar represents one day. The same exact thing can happen on a 5-minute chart, on a 10-minute chart, on a 30-minute chart, on a 1-hour chart. So if you wanted to go down to lower time frames so you can trade quicker, same concept applies. All right. So boom. You get in here, right? And then we're just for the sake of keeping things simple, we're just going to imagine we're trading common shares and we're not trading options. All right, so you get in here on October 17th, 2 days later, you hit your price target, right? Right, the price comes to the same area or just below, or just below it, right? So either you could sell off some here, or you say, nah, it doesn't quite hit my price target, whatever, I'll let it rock. And then your stop loss could be the same area. So then it falls back again and it starts to rise. This time it actually hits your price target. Boom, you take some profit. So let's say you had 1,000 shares or 100 shares to keep the math simple. Here you hit your price target and then you sell out of maybe a third or a fourth of them. And then price keeps running. Boom, hits your second price target. Sell off another third or fourth of your shares, right? So the first time you sell 25, right? That's 20. That's a fourth of your shares. So now you have 75 shares, right? And then it hits the second price target, and you're gonna sell off 25% of your shares. So you have 18.75. So we'll say you sold off 19 shares, right? So boom, you have 56 shares left. All right, price comes down, eventually stops falling, then it runs up, and then you just let your position hold forever until you hit this price target, in which you hit this price target over here. So the whole trade took like 2-3 months to play out, but you finally hit your price target over here. All right, so that's just a quick example of how you set your price targets. You set your price targets based on where the price fell from. The previous highs and where price falls from is where you can set your price target. All right, so just a quick update or refresher for people who maybe haven't even seen this. So if you're to get in a trade here, right? Let's say you start buying some because you see the price is consolidating. Where's your price target? It's going to be here. All right, you could say price fell from here, so here's going to be my price target. Or you could say price target 1 is going to be from here. All right, cool. You start loading up, you're accumulating. Price is just trading sideways, eventually breaks out. It hits this price target. Boom, you sell some off, runs up, pulls back, it runs up again, right? And because it pulled back here, you can put this as a price target too. Then boom, you hit your price target. All right, so if you think of trading that way, it's very simple. All right, moving along. Where's SPY at? So SPY keeps hitting the same area and rejecting, right? So we need price to go above this area for us to be bullish at this point, right? So if we don't, then we can expect the pullback to be here. All right. So maybe we come down, touch 400, come back in this area, and then run up. Or if we do eventually go through this area, then we're likely to go up here where it fell from. Boom. All right. So to the upside, we have a price target here in this area. To the downside, we have a price target here in this area. All right. If you break either side, you just keep it going. Right. You break this area here, you would have to go back, pull back, go further back on the charts to see what's the next level above this. But here you just go down. That's the next. That's the next. Boom. All right, cool. With that being said, the market can go either way. So you want to just go chart things looking for good setups. All right. Remember I told you guys about busting open ETFs. So I have the ARKG ETF, and I'm just going to search through it. So let's start here. ABBV. All right. Boom. This is set up perfect. First stock in the ETF is set up perfectly. Look at the RSI is below 28. Boom. So we got a cold RSI. The price hits the moving averages. The moving average to 200 and it stops falling. So you're like, all right, cool. Now we start to see the histogram tick upwards. So you're like, all right, maybe this thing is done falling, right? So ultimately you want to see it trade sideways for a few days, 3-4 days, and then you can expect a bounce. So it's something you should keep your eye on. Now, if you just strictly look at the percentage of how far, where would the price target be, right? You can set your levels right here. Boom, you see how price ran up right here, then it fell, and then it ran up, and then when it fell, it stopped here. All right, so look, when it ran up, it stopped here, then eventually it goes through, and when it falls, it stops here again. And so this was a resistance here, and then when it breaks through, it becomes support. All right, so when it finally breaks this support, so it comes all the way up here, right? So if you were to start this trade here, your price target would have been here, right? In which you hit it. All right, cool. Now, it breaks the support and it comes all the way down here, right? And when you set your price target to trade it back to the upside, this is your first price target. Make sense? If you can get that, you can make money. All right. Now, so I like this setup, right? So this would be price target 1, price target 2. Cool. So it won't make a move. Oh, what I was going to say is that look at this percentage change from here to here. That's the 12%. So maybe you would want to trade options here and not swing trade shares, right? When you look for swing trades, you're looking for a 20+% move, not 12%. So with that being said, even if this does move, you'd probably be better off buying some call options, right? So prices at 146, maybe you buy some 150s that are a week out, right? Maybe when the market opens here in 20 minutes, you buy some 150s. It's at 146. As it moves closer to 150, boom, you get your money, right? Matter of fact, we can go see what this is looking like in the pre-market too. Down 50 cents in the pre-market. So those 150s will expiring this Friday will probably do the trick. If I end up buying some, I'll let you know. All right, and then you're just gonna click next. I'm just gonna go through this whole ETF looking for. Nope, too hot. See that 70 RSI? It's already up here. It's at this price target. Matter of fact, you could buy puts on here because there's a gap, and these gaps fill. So you buy puts on here. This will probably eventually fall out the damn sky and come back down in this area because this gap has to fill, right? So if I'm thinking, okay, the SPY's probably hit the resistance level, now it's time for the market to come back down and cool off, then I would take this trade. If I think the SPY is going to take off and blow through that 407 resistance and keep going, I'd be more likely to take this trade, right? This is set up. If the market is to go up, this is already at the bottom. If I'm expecting the market to come down, I know this has a gap to fill. The RSI is already hot. I'd probably rock and roll with this, right? A $10 call here. So I'm just going to click this until I see something too hot. And once you have, this is what you spend your weekends doing. And once you have these ETF set up and these chart lists set up, you can literally just click next until you find something worth taking a trade on. Okay, like here, for example, right? I would expect this to come down and test this support. If this tests this support down here at 192, then I'd be more interested in buying it. But at 211, I think it could keep coming down more, right? Look how many times this hits. Look how many times this hits the level of support here, this area. So I would expect it to test it again. I'll stay away from that. And you just keep going. Keep going, keep going, keep going. All right, so these are the stocks that make up the ARKG, which is the ARK Fund Invest, the ARK Investment Trust. So they have the ARKK, the ARKF, the ARKG, so on and so forth. So all right, once you go through this entire list, looking for your setup that you like, you can move on to the next one. Let's go check the XLV. Oh, this is hot. Another one. So for instance, this RSI is getting cold, but I would probably expect this to touch this 200. I expect this to come down probably 3 more points, right? At least to the top of this 292. It looks like it touched it a little bit. This is something I would keep my eye on, but not make a move with yet. All right, once you run through either your whole list or enough of them till you get the point, you can move on to the next one. And this is like a method that you can use to find your investments or to find your trades, right? All right, now let's build off of what we started last week. So we get it. We figure out how to set up the list. We figure out how to just click through them. We know what we're looking for. Predefined scans will help us get to where we're going even faster. Bullish MACD crossover. New York Stock Exchange. There's 21 stocks listed here. Let's click that number 21. And now we have a list of everything that the MACD is ready to cross over to the upside. So let's go look at it. Tilly's. Cool. So if I were to trade options, I'd be looking at this $9 call, maybe 9 1/4. right? And then you can just click back. You can go from A to Z. You can even filter this by volume so you can see what the stocks are getting the most action, and then link, and then just chart everything. All right. CVS, we caught CVS last week on a call. We hit for 56% on CVS. And how do we find it? The same scan. Walmart, maybe I buy 145 calls on Walmart. Lockheed Martin. And this is just how you're going to find what you feel comfortable trading, right? There's a lot of things that you can do in the pre-market. You can go look and see what's moving in the pre-market. You can go set the levels for your pre-market highs, your pre-market lows. You can go do all that. I'm just giving you, a few tools every video. AutoZone, let's see what they're talking about. Now, if you are going to trade options, you still have to go look at the options chain. Looking at the stock chart isn't enough. Why? Because you're not trading stocks. That's something that you guys got to understand too. You're trading the contracts of the stock, not the stock itself. So you need to look at those different contracts as well. So this method is very simple if you're just going to swing trade common shares. If you're going to trade stock options, then you need to look at those actual contracts. Maybe in the next video, that's what we'll do, is bust open some the option chains and look and see what we can find. All right, we got 12 minutes until the market opens. This is kind of what I like the most. Where's it? Abby. All right. So, and I know it's down 50 cents in the pre-market. So I'll keep my eyes here, and then also want to go to this weekly. Kind of see what's going on. And then even go down to hourly. I think I might get in some calls here. But anyways, y'all, just some more tips for you guys to use, man. All right, you should know what you're looking for. You should be able to set price targets at this point. All right, your price targets are based on previous support resistance levels or the previous highs. All right, you can understand that. You can trade. So our next video, we'll just keep building on what we're learning.